Welcome back to Investing Talk Podcast. We're here to sift through the noise and bring you some clear insights. Today, we are taking a close look at Celanese. They're a major global player, in engineered polymers and specialty materials. And the big question, really the core of our exploration today is this. Is Celanese a good time to buy right now? As we get into this, if you find value in these discussions, please do consider subscribing, maybe like this exploration, and leave us a comment. Your engagement really helps us keep bringing these kinds of analyses to you. Oh, and if there's a specific company you'd like us to look into next time, just let us know down in the comments below. Okay, so Celanese, we've got a stack of analysis here, covers everything from recent financials, market sentiment, to these long-term projections and the risks involved. It's kind of a fascinating case, isn't it? Because, on one hand, you see this company with a really strong industry footprint, but then on the other, there are some, well, pretty concerning financial signals right now. Let's really try to unpack this paradox.
Yeah, that contradiction is exactly what makes it so interesting. And to even start answering if Celanese is a wise investment right now, we absolutely have to ground ourselves in its current financial health. So our sources, looking at the fundamentals up through July 2025, show Celanese pulled in about $10.06 billion in revenue over the last 12 months at TTM.
Okay, 10 billion. That's a pretty solid top line.
It is. But, and this is a critical piece that just jumps right out, they reported a net loss.
Yeah.
A pretty big one. Around $1.65 billion over that exact same period.
Wow, a net loss of $1.65 billion on $10 billion in revenue? That's big. That's a significant. So if they're losing that kind of money, what does that translate to for their earnings per share? We talk about EPS a lot, but how does that work here?
Exactly. That net loss directly means negative earnings per share. It's hovering near negative $15. And just to clarify, EPS, earnings per share, that's basically the profit per share of stock. Negative means, well, they're losing money on a per-share basis, a definite red flag. Now, their gross margin, that's revenue minus cost of goods sold. That's actually respectable, roughly 23%. So they seem efficient at making their stuff.
Okay, 23% gross margin sounds all right.
Right, but the net margin tells a totally different story. It's deeply negative, around negative 16%.
Negative 16% net margin. What does that really mean, though, beyond just profitability challenges? Because making all that revenue but still losing money, it just sounds like they're facing some incredibly tough headwinds.
It really does. I mean,
Yeah.
A negative 16% net margin isn't just a challenge. It means for every single dollar of revenue Celanese brings in, after all the expenses, interest, taxes, they're actually losing 16 cents. So it indicates, their operating costs, maybe interest on debt, other overheads are just too high compared to sales, or maybe their pricing power is really limited right now. Either way, they're effectively bleeding money.
That really puts the spotlight on their debt situation then. What does the analysis show about Celanese's leverage? Because, yeah, losing money and having high debt, that sounds like a dangerous mix.
Yeah, this really does raise an important question about their financial stability. Celanese's debt-to-equity ratio is, well, it's alarmingly high. It's about 225%.
225%.
Yes. And just to put that in perspective, it means for every dollar of equity, like the ownership stake, they're carrying $2.25 in debt. That ratio really points to significant leverage risk. It shows they're heavily reliant on borrowed money, not their own capital. And while the sources didn't give us super detailed cash flow numbers, a large net loss combined with that much debt, it strongly implies serious cash flow pressures.
So they're probably burning cash just servicing the debt.
Very likely, which of course limits their ability to invest in growth, manage day-to-day stuff, or even just weather any unexpected economic storms. It makes them financially vulnerable.
Okay, so with these numbers, big revenue but big losses, negative margins, really high debt. How does Celanese still, hold its ground in the industry? What's the bigger picture here?
That's a really crucial piece. Celanese operates in this specialized world of engineered polymers and specialty materials. It's not just commodities, it's highly technical stuff, often customized. They have a broad product portfolio. Think high-performance polymers used in everything from, say, medical devices to car parts, thermoplastics, even pharmaceutical-grade materials. These are critical components for a lot of industries.
Right, so they make things people really need, specialized things.
Exactly. So despite the current financial mess, they undeniably have a strong market presence and a reputation for technical know-how. But it's also an industry that's famously cyclical, and it's vulnerable to input cost risks. Meaning demand for their products tends to rise and fall with the broader economy. If manufacturing slows down globally, boom, demand for their materials drops. And their profits are heavily tied to the cost of raw materials. Think crude oil stuff, natural gas, other chemicals, which can swing wildly. This cyclicality and cost sensitivity often lead to these, well, boom and bust cycles in their earnings.
Okay, so it paints a picture of a company with like a strong foundation, but maybe dealing with some serious current injuries. Given those financial issues and the industry cycles, how's the market actually valuing Celanese right now?
Well, that's where it gets interesting because the market often tries to look ahead, right? Since they have negative EPS right now, the trailing PE ratio, well, it's meaningless. You can't really calculate it.
Right, no earnings, no PE.
But the forward PE, which is based on what analysts expect them to earn in the future, is around 10.2.
10.2. So the market is pricing in a recovery.
It definitely suggests that. A forward PE of 10.2 means the market anticipates a return to profitability. Investors seem willing to pay about 10 times the company's projected future earnings per share. It signals a belief that maybe these current losses are temporary and a turnaround's coming.
Okay, this is where it gets really interesting for me. What about the analyst price targets and those much longer term outlooks? Because I noticed a pretty striking difference in our sources there.
You're absolutely right to flag that. It's probably one of the biggest contradictions we're seeing. Analysts, on average, have a near-term price target around $69.78.
Okay, so from where it is now, around 57 polars, that's maybe 20–30% upside. Modest.
Yeah, modest appreciation potential, suggesting they see some recovery or stabilization soon.
Yeah?
But then you connect that to the bigger picture, this long-term discounted cash flow or DCF forecast.
Yeah.
Well, it paints a dramatically different picture.
Right, the DCF. Remind us quickly, what is that and why is it projecting such a different future for Celanese?
Sure. A DCF analysis basically tries to estimate an investment's value based on all its expected future cash flows. It projects earnings way out into the future, like 2030, 2040, even 2050 in this case, and then discounts those future flows back to what they're worth today. Because a dollar tomorrow isn't worth as much as a dollar today.
Okay, makes sense.
And this long-term DCF forecast for Celanese, it shows the price could potentially rise substantially. We're talking a range of maybe $209 up to $472.
Whoa, $209 to $472. That's an astronomical difference compared to the near-term target, like a potential 3x to 8x increase from today. What kinds of big assumptions or massive shifts are baked into that long-term view? Is it just a sector recovery, or are they assuming Celanese pulls off something huge, like breakthrough products or something?
Yeah, this is exactly where the whole story around Celanese gets tense. That massive long-term number isn't just wishful thinking. It's based on some pretty specific assumptions playing out. Our sources suggest a few key drivers. First, it assumes a big sustained rebound in the whole chemicals and materials sector, getting past this current downturn. Second, it likely models Celanese successfully deleveraging, basically, cutting down that huge 225% debt-to-equity ratio significantly. That would free up cash and cut risk.
Okay, that makes sense. Less debt is good.
Definitely. Third, and maybe most important, it anticipates them really executing well on strategy. That could mean successfully integrating past big acquisitions, like the DuPont Mobility Materials deal, getting those cost savings and market share gains. And also implies a strong pipeline of new, high-margin specialty products, maybe breakthrough stuff for like advanced batteries or sustainable packaging, or getting deeper into medical and pharma markets.
So the long-term models are basically betting on a major transformation, better efficiency, innovation, capitalizing on big trends over decades.
Pretty much. It's a bet on them navigating the cycles, fixing the balance sheet, and innovating successfully over a very long time frame.
That's quite a vision, but yeah, clearly a long way off. Which brings us back to today. How is the stock actually behaving now? What's the volatility story with this kind of tug-of-war going on?
Well, the volatility definitely reflects that tension. Celanese has shown some pretty big price swings. Its recent trading just the last few days has been fairly tight, maybe between $56.86 and $58.10. But you zoom out to the 52-week history, it's much more dramatic.
Yeah. What's the range been?
The lows are down near $36, while the highs actually went over $140.
Wow, $36 to over $140. That's huge.
It is. And the current price, around $57, is definitely in the lower half of that 52-week range. Now, this might signal it's undervalued, maybe oversold because of the recent bad news or market caution.
Oh.
Or it could just reflect genuine ongoing weakness that's keeping the price down. Its beta, which measures volatility against the market, is 1.13. So it tends to be just a bit more volatile than the overall market.
Okay, so the price definitely shows a lot of uncertainty. What about the general market sentiment? What are analysts saying overall? Is it buy, sell, or just wait?
Right now, the sentiment seems pretty balanced, maybe leaning cautious. Analysts mostly rate Celanese as a hold, And they have those moderate upside price targets we talked about around $70.
So hold means they're not yelling buy, but also not sell. Kind of wait and see.
Exactly. It suggests most analysts want to see some actual proof of a turnaround before getting more bullish. They're watching. The company also pays a small dividend, about $12 a year, which yields around 0.21%. It's tiny, but it's something for shareholders while they wait. The next one's payable August 11th, 2025.
That wait and see approach makes a lot of sense. So for investors thinking about this, what are the key things coming up? What catalyst could actually shift this whole outlook either up or down?
The most immediate and probably most crucial catalyst is their next earnings report. That's scheduled for August 11th, 2025.
Okay, so that's very soon. Critical date.
Absolutely critical. It'll give the market fresh data on profitability, hopefully some improvement, and importantly, management's updated guidance for the future. Strong guidance, any positive surprises that could really move the needle upwards. Beyond that, you have the big macro factors. Trends in raw material costs, especially chemicals and energy, if those drop significantly, it could boost their margins.
Right, input costs are key.
And changes in global industrial demand, maybe a stronger rebound in manufacturing or automotive than expected, that would help sales. Plus, any major strategic moves from the company itself, new deals, asset sales, aggressive debt paydown plans, those could be catalysts too.
Okay. And on the flip side, the risks. We know about the debt and losses, but what else should we be really watching out for?
Yeah, understanding the risks is absolutely vital here. The main company-specific risks are the ones we've hit on. That super high leverage, the 225% debt to equity, the recent net losses, negative earnings, all raising big questions about financial stability.
Especially if things don't improve quickly.
Exactly. Servicing that debt gets tougher and tougher when you're not making money. Then you've got sector risks. That cyclical nature of chemicals downturns hit demand and pricing hard. Commodity price swings, if raw material costs spike suddenly, it squeezes margins fast. And maybe regulatory changes, especially around environmental stuff, could add costs.
And the broader economy.
Yep. Broader macroeconomic risks are always there. A global slowdown would definitely hurt demand across their markets. And things like supply chain disruptions, which we've certainly seen, could impact sourcing materials or delivering products, hitting both revenue and margins.
Okay, so bringing this all together, looking at the numbers, the market view, the potential catalysts, the clear risks, what's the final assessment? Is Celanese actually a good buy right now? Where do we land?
Well, based on everything we've looked at across the sources, Celanese currently rates, let's say, a 5 out of 10.
Right in the middle.
Exactly. It definitely has a solid position in its industry, with its specialized products, and benefiting from some long-term trends. And that potential for huge long-term growth from the DCF models, that's certainly appealing. But it is undeniably facing some major near-term financial hurdles, those losses, that debt load. The overall hold consensus from analysts really captures it well.
Yeah.
It's not a strong buy, not a strong sell.
Yep.
It's nuanced.
Given that nuanced picture, that 5 out of 10, if listeners are thinking about a potential position, what's a reasonable entry range? Maybe more importantly, who is this stock really suitable for? What kind of investor?
Okay, so for investors maybe looking to build a position, especially with the volatility, getting in around the current prices, say, that $56 to $60 range could be seen as reasonable. If you can get closer to $56, obviously that helps your risk-reward ratio. Now, for short-term traders, I'd say caution is very much advised. That high volatility plus the upcoming earnings report, it could swing the price significantly, making it a pretty risky short-term bet.
Yeah, earnings could be a real gamble.
Right. So if you're a short-term trader here, using tight stop losses is probably essential. Maybe 5–7% below where you get in. Like if you buy at $57, maybe put a stop around $53 to limit your downside.
And profit targets.
For short-term gains, you might initially look towards that $7 to $75 area based on those near-term analyst targets. But for long-term investors, folks with patience and probably a higher tolerance for risk, Celanese could be considered maybe a cyclical turnaround speculative hold.
The speculative hold.
Yeah, these are investors essentially betting on that positive earnings recovery happening and then sustained growth over, say, the next 5–10 years or more, aligning with that really strong long-term DCF forecast. For these investors, though, monitoring key milestones is absolutely crucial. Things like seeing aggressive debt reduction, a clear, sustained return to making profits, and evidence they're successfully executing on their strategic plans. It's definitely a long game, requires conviction and keeping a close eye on things.
So wrapping it up, our look at Celanese shows, well, a company really at a crossroads. It's kind of Medium risk, moderately valued right now, definitely has that robust long term potential, but it's also navigating some pretty serious short term problems. It really seems like it fits better as maybe a cautiously held long term stock for someone willing to ride out the bumps and bet on that turnaround rather than a simple short term trade. Unless, like you said, you're super disciplined with risk management, especially around earnings. This whole analysis really brings up that classic investing tension, doesn't it? How much weight do you, as an investor, actually put on a company's projected long term future, that shiny vision way down the road when its present reality is, well, struggling with debt and losses? It's a really delicate balance. Thank you for joining us on Investing Talk Podcast. We hope this exploration helps you make more informed decisions. We'll see you next time.